We've got a special episode of Ready, Set, Grow this week. Impact Radio host Randy Cook sat down with some titans of the financial industry. Jeremy Siegler of the Wharton School of Business, Robert Shiller of Yale, and Thomas Haynes from Annexus. They talked markets, interest rates, the Fed. Robert Shiller shared some insight into his wheelhouse, commercial and residential real estate, and all three talked portfolio construction, bonds, fixed products, and how they can impact a retirement. Be sure to like and subscribe, and when you're done here, check out Randy's series, Selling with Stories, where he breaks down the do's and don'ts for financial advisors when it comes to talking about tough topics with clients and prospects.
4, 3, 2, 1!
Welcome, everyone. I'm Randy Cook. I'm here today with a couple of financial heavyweights. We are here with some very recognized names in the financial world. Professor Jeremy Siegel, of course, of the Wharton School of Business, Professor Robert Shiller of Yale, and Tom Haynes of Annexus. Gentlemen, it's good to have you with us. We got a lot to plow through here today. Economic issues, retirement issues that we're dealing with right now. But before we go any further, we've seen you two, Robert and Jeremy, on TV an awful lot. And what I have found out is that you two have been friends for, is it 50 years? Jeremy, you guys get together, you go on vacation together. Tell me a little bit about that.
57 years, 1967. So
Wow.
That's 57 years. I met him just at the very beginning of graduate school at MIT. We both got our PhDs in economics, and we were in the same class. And we've been friends for over a half a century. We vacation together up in the Poconos on the Jersey Shore, and we visit each other, and it's been a wonderful friendship.
Robert, do you two ever disagree? I know that when my family gets together, you start talking about politics and money, and somebody says, "What do you mean by that?" And it's on. Do you have any experiences where you two have disagreed like that?
Well, I have had a history of being less optimistic about the stock market. But that's partly something I've learned from Jeremy. I've learned about the real world, and the market isn't it turns out not to be that much of a disagreement between the two of us. We have a different.
Gotcha. And Tom, have you seen these two in their natural environment with T-shirts and shorts on? And how does that work?
Well, that's what's great, right? We are so fortunate to be with two great legends in academics and financial economics, and just to take off the hat of that for a second, or the tie, and hear Professor Siegel. He's quite the Renaissance man. He can talk about what's going on in sports, society, certain aspects of entertainment. And same with Robert Shiller, great fathers, grandfathers, which is pretty special. And yes, I have seen them definitely also debate when it comes to valuation of equity markets. Also different formulas, different approaches, but great minds come together.
Well, we're going to ask some questions today, as I mentioned, about retirement, about markets, about interest rates, about residential and commercial real estate, and everything that's affecting us right now. And as I ask a question, I might put it to one of you, but I would like for all of you to kind of get into it as we go through today. So, Professor Siegel, let's just start with you. I've watched and listened to a lot of opinion about the Fed and the interest rates and all that's been going on. Some say that the Fed has been too aggressive. Others say that they haven't been aggressive enough. Some people say that their sway is too much on the market. As we look back on this, perhaps 5 years from now, you look at Jerome Powell, what would you say? What are people going to say? Did he get this right?
He's getting it right now, much better, but he got it terribly wrong at the beginning of the pandemic. And in fact, I blame him quite substantially for all the inflation that we had, keeping interest rates really at zero, letting the money supply explode in 2020 with the pandemic, and in 2021 did not really start tightening until March of 2022, way too late. Now, since then, the performance has been much better. Certainly in the summer earlier, I was worried that he was not reducing interest rates enough. I believe short-term interest rates should be down further. But he's done a much better job over the last 2 years, certainly than he did in the first two since the pandemic.
Professor Shiller, your thoughts on that?
First of all, I wouldn't put it all to Powell. He's part of a distinguished institution, the Federal Reserve System. We have a research department. There are many members of the Federal Open Market Committee. So I think we should be basically grateful to them as they brought us into what looks like a soft landing. You know, there's a little bumps in the ride, but we don't know what would happen if they had done differently. So I give cheers for the current Federal Reserve researchers and FOMC members.
Tom, you look at things probably from a perspective of financial advisors, how they're helping their clients, your company, how they're helping their clients, retirees, and how they are, in some ways, benefiting from the higher interest rates. Your thought from your perspective?
It's a great question, Randy. When interest rates go up, there's obviously younger families that are challenged with having higher mortgage rates to deal with if they're trying to buy a house. But in the case of a retiree that is saved through their retirement and into retirement, and they have the assets there to utilize through their retirement, it has actually been a great way to invest in certain financial products. That means higher market-linked CD rates, higher bank account rates in some instances. Some of those are a little short-lived. In other instances, for example, what we do at Annexus is we build index annuity products. Mm-hmm. And by having that jump in rates over the last few years has really increased the competitiveness of the offering of index annuities. To the term we'll call it almost the retirement refinance opportunity. So if you had purchased products even previously in the lower rate environment from quantitative and easing era of, let's say, 2009 to 2020, and you're looking to make one more move into a product, this is a great time to be able to roll into that. And the reason why is insurance companies are really backing that policy based on investing in longer term bonds and in fixed income that offer a higher yield to them. And as a result of that competition, the well-rated insurance companies can pass that opportunity to their clients.
Professor Shiller, as interest rates now try to change and they're starting to go down a little bit, this has been very interesting for housing because as people buy houses, they buy carpet, they buy furniture, they buy curtains. It's good for the economy when housing is doing well, but as interest rates start to go down, it's interesting what's happening right now, and I see two scenarios that I have heard. And number one is as the Fed cuts rates, people will rush in right away and say they want to buy a house. Then you've got a lot of competition for each house, and the price will actually go up on the house. Or the Fed slow rolls this thing, and people say, well, why should I go at 6.5% when I could go at 5.5% a year from now, and that will actually slow the economy. Your thoughts on the interest rate effect on housing and how that's affecting the economy?
Well, it could go either way. We're talking about home buyers. They're not PhD economists. And there may be an effect of hearing that they're lower for some buyers, and they'll want to jump right in. And others who are, I would say, a little bit more sophisticated might take the other course. I'm not one who thinks that there are easy ways to understand. We're talking about ordinary people, real people, making decisions that are emotionally laden anyway, and they have often they're couples that have to make an agreement between the both of them and figure this dilemma out that you just described. I don't think they can do that very well.
Mm-hmm. Professor Siegel, any thoughts on that?
Yeah, well, one of the interesting things is you are right. The Fed is lowering interest rates. So short-term interest rates are going down, but long-term interest rates are actually going up. Mm-hmm. And this is something that I actually am not at all surprised about because I think that this lowering of interest rates has the potential to stimulate the economy, lower the risk of recession, and that's positive for long-term yield. So if you're actually in the market for, let's say, a 30-year fixed rate mortgage, you may find it higher a year from now than you do today. I actually think long-term bonds should settle somewhere around 4.5%, plus or minus. We're not there yet. But if you go into an adjustable rate mortgage, of course, a very short term, then I'm sure you will see those rates down. But so far, people seem to be surprised. But I think if they study a little bit about economics, they shouldn't be, that actually, since the Fed became more aggressive, about 3 weeks ago in September, that actually mortgage rates and long-term interest rates have risen. So, and in addition to all the things that Bob has said, I'm not so sure that we're going to see a rush of gains in housing. Housing has been really strong. It was really strong 2020 to 2022. In fact, by my measurements, using Bob's valuable data that he has collected all the way back, I think it was the greatest 2-year increase in housing prices that we've ever seen. Now, its increase has been much more modest since then, and I think it will be modest. Certainly home prices are higher than they have been relative to rents and relative to historical trends than we've seen in a long time. So mortgage rates long-term may not go down. I'm not expecting any big rise in housing prices over the next 12 months.
Well, let's follow up with that and talk about the commercial real estate market, because that's something that really is kind of teetering as well. And I'll start with you, Professor Siegel. During COVID, we all kind of figured out we don't have to go to work anymore in the office. A lot of people were working at home 5 days a week, and now are probably working at home 3 days a week. And now we find downtown office buildings that are completely vacant. A lot of regional banks own those notes. So you've got a lot of empty buildings. They can't pay their mortgage. We've already seen 3 regional banks go under. Do you see this as becoming a bigger problem, or are we already through it?
Well, I think that commercial real estate, especially older commercial real estate, the older buildings, they're going to be in trouble. I think that's discounted in many of the prices of regional banks, which, as you correctly say, own a lot of that paper. There'll be a lot of workouts. I think we're going to see a lot of bank mergers, honestly, with a lot of some of the regional banks merging with others. You know, we are really, in some ways, the most overbanked country in the world. The number of banks per person is far exceeds almost every other developed country. So there might be some room for that. Grade A buildings are holding their own. The rest of real estate, outside of commercial real estate, is doing well. So that to the extent that they hold those, that's going to be fine. But no, there's going to be a lot of workouts. There's going to be a lot of pressure. They're not going to fill up again. I know that some firms have mandated 5-day weeks, but I don't think. I think 3 to 4 day weeks is going to become the norm, and that's going to put pressure on these older buildings.
Professor Shiller, the regional bank situation, your thoughts on that?
I think that the work-at-home revolution is a major revolution because a lot of, let's not just look at GDP, let's look at human happiness. Friends are important. Neighbors are important. If your job is going to take you away because the firm has changed or business plans have changed, you had to move. You had to pull your kids out of school and make new friends. And you'll know it's only temporary until the job market takes you away again. So this is positive. And I think Jeremy is right. It's going to be with us. And I think we've discovered something that was hardly imagined before, that a situation in which you spend roughly half your time at the office and half the time at home is going to be enriching and invigorating. And you'll be with your children more. I think we've learned that can work. So I'm inspired by this moment.
Good deal. You talk about the difference between narratives and things like that. This has actually become a new narrative in our country, hasn't it?
Yes. Well, there is an old narrative about technological unemployment. Mm-hmm. It was described by Aristotle before over 2,000 years ago. And he said in one of his books that if they figure out how to, I'm quoting him loosely, how to make the plectrum do the loom automatically, that may lower the need for workers and slaves. And so it's exactly what we are. But they had inventions that were coming up in ancient times, like water wheels that would power some device. And it comes up now and again. In my book, Narrative Economics, I liken narratives, or memes as some people call them, to viruses. They're contagious. And they may be contagious we become immune to them. We forget about, we're bored by them. And then it comes back with a mutation. So, for example, we have presidential candidates who espouse different policies, and they become personalized, and there's human interest. And we like to tell stories about they're more interesting than the dull discussion of economic incentives.
Well, Tom, one of the things in your space about retirees, you're constantly working with people and finding how to fill those needs. One of the things that could be a demographic kind of switch in our country is the fact that baby boomers probably have that 2 or 3% mortgage in their house right now, and they've got 4 bedrooms and their kids have all moved away. They want to downsize their house, but they don't want to upsize their mortgage. This could actually be, I've heard a lot of 30 and 40-year-old people saying this is one of the things that's very difficult for me. I want to buy a house, but there's nothing out there available because baby boomers won't move out. Do you see this as being a demographic switch, a difficulty for new people moving in? I know that some of the political candidates are talking about building 3 million new homes. Is it all an inventory problem that will solve this particular issue?
So, Randy, you're probably hitting more of a personal nerve than really coming through my Nexus perspective. As a son that has a mother, a widow outside the Philadelphia area, and I see my in-laws also as they get older in their 70s. I feel that we, as society, have not done enough. And I'm talking to people in their 70s, but for the baby boom generation. Everyone knew that demographic was coming. And two things unfortunately happened. I don't think we provided enough smaller housing in their communities. Just because you need a smaller house or dwelling doesn't mean that you should have to give up on being a part of your community and relocate to a different community. I think it was a major miss that only a few communities were able to offer. Maybe Professor Siegel had the prowess to live in an apartment, so he's been able to be in that dwelling for so many years with his wife, Ellen. That's number one. The other issue that I don't know enough of the history, but when in 1997, the tax relief for seniors to sell their house and not hit the capital gains, that went away. And now I think when you see you're faced with a limited supply of senior housing that has also been inflated, high rates, and knowing that you have to pay high capital gains on what you have, it's really frustrating. So I personally, it's a long answer to say, I wish we do more for seniors right now, and I would advocate whoever wins the presidency, who's in Congress out there, if you're listening on the airwaves in Congress, try to fix that as opposed to just also focus on the younger people, because if we can have those elderly and baby boomers downsize, that'll create the supply for the younger families.
Well, let's talk about that particular person right now watching financial news, and I'm looking at two guys right now that are on that financial news an awful lot. Professor Siegel, you're there a lot on CNBC and other financial networks to give your opinion on what's going on right now. And many times I'll hear this phrase, history tells us this. And they go back and they compare what happened 30, 40, 50 years ago to what's happening today. But I think that we all know that the markets are ruled by very different sets of rules from 30, 40, 50 years ago than they are today. Can we take it seriously when someone says, history shows us this? Does it have any relevance whatsoever?
Well, I mean, sometimes yes, and sometimes no. In fact, I think too many people look at one or two past incidents and think that is convincing. Like the market goes up 5% after the Fed lowers the Fed funds rate by 50 basis points, and they point back every time, every really timeline is unique. Every point in history has unique circumstances. Now, I understand that you have to learn from history too, because it also has lessons. The famous statement, if you don't learn from history, you're going to repeat the same mistakes as you had before. Now, for instance, I remember being, saying that the inflation we were having 2001 and 2 and 3 were a result of tremendous increases, record increases in the money supply. Now, where did I learn that from? Milton Friedman, when I was a colleague of his at the University of Chicago. He wrote the book, The Monetary History of the United States. He went all the way back to 1865 and showed that and that was convincing. So that time was the same. But we often tend to overstate it, like, this week is a good week historically, or this month is a bad month historically. We often heard September, which is historically not a good month in the market, and yet we had a good month in the market here in 2024. So one has to realize that sometimes, yes, you can really learn from history, but I think that too many people take one or two or three incidents, not taking the different circumstances around them, and think that they now have a way to predict the future. I remember one of my thesis advisors and professors at MIT, Paul Samuelson, say we only have one sample of history, saying that we cannot run an experiment 100 times like a physical scientist to prove that cause and effect and one leads to another. Really, we can try to learn from similar circumstances, and sometimes we can, but oftentimes we have to realize the uniqueness of the situation.
Tom, one of the things that happens with people who get into their 60s, they get close to retirement, and all of a sudden they watch a lot of financial news. They start watching the up and the down, the daily of the market, and we see these things happen all the time. We get a report, an inflation report, a GDP, something, and the market reacts. And then a month later, we get the revision and the market reacts. And so here I am with my money in that market. It's going up and down. And all of a sudden, the daily of the market is really starting to worry me. What do you say to retirees who are watching this by the day?
Well, it's easier said than done, but our recommendation is really to have a longer term focus. I know Professor Siegel actually advocates if you can adjust to your sleeping point, to your point, Randy, you should be all in stocks. Now, at us at Annexus, think that coupled with an equity portfolio, if you're going to have bonds to adjust to your sleeping point, replace those with index annuities, providing better guaranteed lifetime income, an accumulation engine that we think has more robustness in the bond market. But that being said, if you're focused on just the recencies of that, you're going to have your sleeping point's going to just be way too low, right? You'll be all in cash. And number two, you're likely to fall prey to bets of the market, bets of selling equities too much or chasing one or two stocks. or trying to second guess what your advisor's doing, as opposed to having a longer term holistic portfolio that tends to be more robust throughout time. You don't want to be deaf to what's going on in the economy, right? You should be asking your advisor and meeting with your advisor a few times a year. So you want to be educated for those meetings, but you don't be rash and abrupt with daily decisions.
Professor Shiller, one of the things that we've been following over the last year or so is the Magnificent Seven, those 7 tech stocks that have held the market up for such a long period of time. And I heard it over and over again. How can we survive when 7 stocks are holding up 493 in the S&P 500. So we've had times like this before. In the 60s and 70s, there was the Nifty 50, there was the Four Horsemen, and at the end of that run, we usually went into a recession. So do you see the same thing happening? This kind of gets to your narrative again with AI and chips. Do you think that that whole tech sector can take the market down with them, or is it starting to even out? What's your thought?
Well, there's some elements of truth in what Jeremy and Tom said. I don't disagree entirely. But I think that markets are driven by stories. And we're not trading against a computer. It's real people. Well, the computer is involved, but real people make decisions. And they tend to start to tell stories. I can tell you the story, one of the prominent narratives is the story of 1929 and the stock market crash. So I go back and read old newspapers. See, this is, you may say, unscientific. Just look at the data. No, but I want to look at what people were saying. So on January 1st, 1929, before the crash, the Standard & Poor's Composite was at a record high. And the New York Times ran an editorial on as they do every year at the dawn of the new year. And they warned about speculation. They said people are putting too much into the market. It's getting too expensive, and this may end badly. That became part of the narrative. It wasn't just the New York Times. And then when the market started to fall, it could have been quickly reversed if buy on dips people were more prevalent. But they weren't. And so you can kind of... Another thing that was happening in 1929 was there was emerging discussion at an intense level of technological unemployment. This was new things, new machines are coming in and replacing jobs. That didn't immediately stop the 1929 boom, but it put doubts in people's head, and then it keeps going up. So people would say, you naysayers don't know what you're talking about. You keep talking about the market's overpriced, but it keeps going up, and I'm missing out on this. So that was a emotional narrative that didn't want to be left out of this revolution. I'll give you an example of the technological unemployment. Telephones were changing over from talk only to dial telephone. Mm-hmm. So you could enter the phone number yourself instead of having to say it to a human being. So they fired all of those operators who were doing the talking, almost all of them. And that kind of thing was happening. They thought it was the future. We're going to be unemployed. You better not waste money now. Don't go on an expensive vacation. And they also began to feel sorry for other people who were unemployed, thinking that, it's like a death sentence. You're done. Nobody wants you anymore. That mood was there, and you see it in the newspapers. So there's no great surprise. The CAPE ratio, which I've talked about as it's essentially price divided by 10-year average earnings, the CAPE ratio was at a record high in 1929. We're even higher now in 2024 with a CAPE ratio of over 36. And so I don't know what it's going to do next with any certainty, but I could see it happening again. But the artificial intelligence revolution hasn't scared anybody yet, it seems. And the markets are holding up. But if the narrative changes, as it did after 1929, it can become oppressive, and we could have a serious recession. That's not a forecast. It's a risk that is greater now, but we don't know what's going to happen. I'm still in the stock market, but more cautiously than before.
Professor Siegel, it sounds like what he's saying is that history doesn't always repeat itself, but it often rhymes. So those headlines that we have today are very similar to what Robert Shiller said 100 years ago, aren't they?
Right. I agree with Bob. You know, Bob really, I consider the founder of behavioral finance and the importance of emotion on how you trade stocks. In fact, in my book, Stocks for the Long Run, I have a whole chapter on behavioral finance, which tells how people feel that they're missing out. Bob didn't mention, of course, the dot-com bubble, which is in much more recent, and I think most of us were not living in 1929, but I think almost all of us were living during that bubble, and that was extreme. In some ways, more extreme even than 1929. And you know, and when that popped, I mean, there were other things going on certainly, but we did have a recession. The Nasdaq went down almost 80% in value. Now, I'm often asked, and you did ask about the Mag 7. Mm-hmm. We are actually, at least by my calculations, I'm not sure about Bob's CAPE ratio here, but we're not as overvalued now at all as we were back in 2000. And I don't use as long a average as Bob does, but we're at a forward price earnings ratio of around 21, 22 now. That's high, definitely, but I believe we're about 30 back then, certainly on projections, forward projections, and actually interest rates were even higher. Long-term interest rates were even higher than they are today. So we were much more overvalued. Outside of the tech sector, we're more at an 18 PE ratio, which I think is fine. I know the historical average is a little lower, but I think there's reasons why PE ratios have migrated upward over time. So I would say the market is slightly expensive. I would say that the tech stocks are quite expensive. They brought home the bacon. There's no question that expression. They brought those earnings in, and people are hoping they'll continue there. Go outside those stocks, you're talking about much more reasonable ratios, and in particular when you go to mid and small size companies, you're really much lower. And if anyone is worried about what's going to happen to the Mag 7, and I agree with Bob, if the narrative changes and AI is shown not to be as revolutionary as many think, we could have a quick change there. Mm-hmm. And that really could cause a shift in the market away from those tech stocks and more towards those stocks which we call the value stocks.
Well, as long as we're talking about allocations, Tom, let's start with you. And I'm going to get into a little bit of equities versus bonds here a little bit. And one of the very common things for a retiree to do is to come in with a 60-40 portfolio, 60% stocks, 40% bonds. And we saw when interest rates started to go up, bonds started to go down. And that particular portfolio did not do very well. Well, now we see that interest rates are starting to go down, which means that bonds could recover. When you think of a 60-40 portfolio, is that something that a retiree should look at going into their retired years? Or do you not feel too good about bonds going forward?
Well, to start, Randy, when we talk about long-term valuation as opposed to getting stuck in the moment, even on bonds, just to give a more calm perspective, the current valuation of the bond yield tends to be the long-term return of the bond. Mm-hmm. You know, late Jack Bogle used to say that, and try to say that from a practitioner view, and I believe that, right? So sure, you could have scare tactics and say, oh, pull away from bonds if rates go up, but long term, where is that? And if the 10-year Treasury right now in October of 2024 is around 4%, think 4 for U.S. government, maybe up in the 5s here for corporate bonds. When you look at the analysis, right, we're not just talking about accumulation. Asset managers tend to do a great job just talking about the accumulation growth, but what about living through retirement, right? The spend down of retirement. And that is always missed, and that's one of the things that we spend a lot of time at Nexus thinking about. We look at that, Morningstar actually comes up with reports analyzing 60-40 portfolios every year. In 2021, they said the idea of having a 4% withdrawal rate out of a 60-40 portfolio is not sustainable. And then this year, after having interest rates going up to 5%, the Wall Street Journal article said the 60-40 portfolio works. The 4% portfolio withdrawal strategy works. But when you open up the report and you find if you're living to 95 or to 100, that's not there. That's concerning. And here we actually are with medical advancements and care. We're seeing more ability for longevity to be within American society, that having one or two or both spouses live to 100 is feasible, right? Especially with all this technology. And as a result, if you're having a retirement horizon of 95, you need to actually have a retirement horizon of 100. So what are you going to do, right? Are you going to spend less in retirement when in the beginning of retirement you have the opportunity to go really spend time traveling, getting a proper, downsizing of your house? Are you going to have enough saved for healthcare costs? And that continues to be a real challenge for retirees. Or otherwise, you're going to think of ways to get guaranteed lifetime income while providing a respectful accumulation engine that can really be a bond alt. And that's one of the things that we really do in the construction of the index annuities that we develop at a Nexus with our insurance partners.
Professor Shiller, you've actually done some research on annuities as a bond replacement, actually using annuities as an asset class. When we've gone through this period of time where the 60-40 portfolio did very poorly, a lot of people moved toward annuities. As a matter of fact, record sales within the last 2 to 3 years. That kind of bears out exactly what you were talking about. Can you comment a little bit about that?
Yes, I think that we're getting more enlightened about annuities over the decades. You have to remember that there were important advances in the past. The invention of Social Security in the 1930s, it gives you a life annuity. And starting in the 70s, I think, it was automatically indexed to inflation. So you were really protected. It's not enough money, though, for us to live the way we want to, but at least you can live on it. I think that we will be. I wrote a book also called Finance and the Good Society, about how we can make life better through finance. These rare inventions that come up in the past could be followed by some new things. Like, for example, you could buy an insurance policy on the value of your house. It can be very bad for you if the house turns out to drop in value right at the time you retire and you're holding on to it. Mm-hmm. So this is it's a good, interesting field. I advise young people to consider going into finance and innovating to produce something that produces human happiness better.
Professor Siegel, I know that you are a guy who comes from, I like stocks, I like those equities. When we bring up the equities versus bonds, where do you fall on that one?
Well, I would say I'm more equity than 60-40. Some of the research I've done has suggested actually that 75-25 is better for most people. Now, certainly it depends on what's going on relatively with interest rates forward. Also, fear of inflation, because equities in the long run are very, very good hedges against inflation. Bonds, unless they're the Treasury inflation-protected ones, are not. So that is another situation. Also, people oftentimes underestimate how long they're going to live. I mean, with advancements in medical science, I've talked to some people retired 65. They say, "Okay, I'm all in bonds," and he's healthy, and he looks to me like he could live 30 more years. And over 30-year periods, 98% of the time stocks beat bonds. Now, it doesn't mean you should be 98% in stocks, but you need inflation protection. You need that long-term differential, which is 3% approximately, stocks versus bonds, measured either before or after inflation. And that, over 10, 20-year periods, that is a big, big difference. But I remember Tom is talking about selling down to the sleeping point. That actually, I believe, was a quotation by J.P. Morgan. When one of his good friends went to him during a bear market and said, "JP, I got too much in stocks. What should I do?" And JP said, "Sell down to the sleeping point."
I love it.
So everybody and everyone's sleeping point is different, and you've got to make people comfortable. For some people, stocks are very scary, and they should be more in bonds, even though they know they're sacrificing return. But also, what Tom said was so important about overemphasizing the short run. I mean, the media and everyone else, oh my God, the Dow is up 300, down 300, up 400, down 400. Some of the best investors say, I look once a year, and if it's way down, I'll buy some. If it's way up, I'll sell some, and I forget about the rest. I mean, we just because that's what makes news, and people love it. And if you're a gambler, you can gamble every minute, and there's one-day options now that people love, and the gambling comes in. But the true value of stocks and the true dominance of stocks, and over 30-year periods, with inflation uncertainty the way it is, stocks actually offer a more stable purchasing power than do the standard non-indexed bonds.
Well, Tom, let's dovetail off of that a little bit because, any industry, any company has to innovate. The insurance industry has had to do just that with all of these baby boomers retiring. We're at peak 65 now. There's more people that are going to turn 65 this year than any other year in history. So there's a new iPhone, there's a new this, there's a new that. What has the insurance industry done to keep up with the demand of the people who are retiring and the people who want that safe money, that sleep well money at night that Jeremy Siegel talks about?
Well, I feel that the insurance industry has been able to take the same concept of, let's say, the index annuity that's celebrating its 30th anniversary, full downside protection, accumulation that really is meant to be an alternative in the portfolio, coupled with key features that I mentioned earlier, like guaranteed lifetime income or an enhanced death benefit to maybe provide for legacy planning. Those are key features, but what we've been able to do along the way, besides taking now you're seeing some of the largest insurance companies, A-plus rated companies, backing these products, which I think is comforting from that perspective. But we're building a portfolio. When the index annuity was invented in 1995, it was one allocation on the S&P 500. And that's a bet. Bets work till they're not working, and we forget about the lost decade. We're talking a lot with Professor Siegel and Shiller about long-term history. And really one of the things that we're beginning to see, and we spend a lot of emphasis at Annexus on, and that's one of the reasons why Professor Siegel as well as Professor Shiller are index partners, is their research, and they've alluded to some of it today, in equities and international equities, has allowed us to develop strategies where we have their research backing the strategies, not to replace the S&P, but to complement the S&P. And that's really what we've been able to do. I wouldn't say the entire industry has embraced that, but we at Annexus really believe that, because in a given year, if there's a zig, the other index could have a zag. And even along the way, and that's why I'm so fortunate to have them as mentors to me, Professor Robert Shiller and Professor Siegel, I've been susceptible to looking at the rearview mirror. You know, in the spring of 2018, I had the fortune of having a lunch with Professor Shiller and with his business advisor, Lawrence Black, and he sat us down and said, gentlemen, we've been in the market 4 years with the U.S. Shiller Index. It's sold a lot, it's performed well, but it's time to complement and diversify with a global index. And I quickly responded. I said, Bob, the Trump trade wars are starting this month. Brexit's a mess. We could have unrest in Ireland. Greek debt crisis is not forgotten about, and we have negative rates in Japan. And he highlighted his CAPE evaluation model showed a better opportunity, right? And he stressed again the idea of diversify, not replace. And we launched the index with very low backtest results. The text messages on my phone, I won't even tell you what salespeople said. But here we are in 2024, and I could tell you over the last 3 years, the 9% annualized returns, if not even higher, clients have gotten if they allocated to the Global Shiller Index. And that's not to say go to the Global Shiller Index. Diversify with the Siegel Index, which was the only index that had positive performance in all the FIA market in 2022, right? A key puzzle piece coupled with the other Shiller indices and other indices. So that's what we're trying to drive, is a decency to diversify, just like you should in your equity portfolio.
Well, guys, we're almost out of time here. One more question to kind of land the plane that kind of sums all of this up. We hear all the time about the retirement crisis. People haven't saved enough money. They haven't done enough financially in their lives. Both of you are educators, and so you have stood in front of students. And so tell me, Robert, let's start with you first. What is it that you want your students to walk away with in your classes that would give them those financial lessons for their lives so that they would be successful financially?
Well, I would say that at this point, what I tell my students is that we live in a country where trust is justified. And when you look at these products like indexed annuities, they looked gimmicky to an outsider at the beginning. And all this math and numbers, but they trusted Annexus and other companies. And I think that was well placed. And so that's my judgment, that it is possible to trust others. Unfortunately, at this time in American history, even in world history, there's a lot of accusations of lying and deceit, and both sides are accused in the election of the. That is damaging to our ability to move forward. I think we have to I'll teach my students that basically success is building trust, and that can be done, and we can get back to a environment where innovation proceeds faster.
Professor Siegel, same question to you. What do you want your students to walk away with?
Well, first, I would say that both Bob's students and my students are pretty privileged students, Yale and Wharton. What I bemoan is financial literacy at a much earlier stage. They're just beginning to introduce these at high school to understand how mortgages work, what savings means, not to overspend your credit card, and how much you're actually spending. That's step number one. And step number two, of course, for people who do make it and then gain the assets, I try to teach people not to be overly frightened about the stock market and put all their money in CDs, like perhaps many of our parents, Bob and mine, our parents grew up in the Great Depression. And, as Bob was talking about, 1929, 1932, the Dow Jones, average was down 90%, top to bottom. I mean, wiping out everyone's savings. Fortunately, we've learned how to manage business cycles better. The worst has been 50%, 55%, and it's bounced back. And in the long run, I remember one reporter once asked me, they said, Dr. Siegel, your book, Stocks for the Long Run, is a great book, 400 or 500 pages. Can you summarize it in one sentence? And I thought a bit, and I got back to him the next day. I say, I will. Stocks are the most volatile asset class in the short run, but one of the most stable asset classes in the long run. And it's really hard to hold on during those bear markets. And if you have a financial advisor that can, teach you the history of that very important fact, I think a lot of people would see their wealth growing at a more rapid pace.
Well, gentlemen, we thank you so much for your insight today. We thank you for your education over the years, and we thank you for your time today. It's been very interesting, and have a great weekend, and we thank you so much.
Thank you, Randy. Thank you, Professor Siegel and Professor Shiller. We really appreciate it and the partnership to Impact.